All right, what's up, everybody? Welcome back to the channel or the podcast, wherever you are listening or watching at. Today, got a very special guest for you guys, a gentleman that's been mentoring me a bit and my wife in this process, but has become a friend. And I think he's got some extremely valuable information to share with you guys today, something he's helping myself and my wife implement in our lives. And I think depending on your situation, because it's got to be a right fit, this could be extremely valuable for you, your family, whoever, maybe just people that you know that you feel like could take a lot of advantage of this as well. So, wanted to welcome Jayson Cahill to the podcast, or again, I keep saying the podcast. I'm shooting this on YouTube. You guys will hear it on the podcast. If you're listening on the podcast, though, definitely come over and watch on the YouTube channel because we're going to be going over some stuff that you're actually going to want to see, some visuals, some real examples of my personal situation. So if you are listening on the podcast, make sure you head on over to the YouTube channel. But Jayson, happy to have you, man. Looking forward to educating the people today about other great opportunities that are out there that can help them start taking back control of their money.
Yeah, thanks, Shawn. It's a pleasure to come on and chat and kind of show what we do with just a niche product towards helping people pay off their mortgage at an accelerated rate with really only changing the direction of the way that the money flows in and out of our accounts. So we're using a first lien HELOC in our example today, to where we're going to set up a checking account, and this is going to be the hub of where we want to place all of our household deposits in. And when it comes in that night at midnight, it's going to move over, decrease the balance of the line of credit. We route all of our expenses out of this same account, and at the end of the month, that's going to add back, or even on a daily basis, it'll add back to the balance. And what we're looking for is that combination of money in versus money out against the loan amount, and kind of finding that right success factor. Every loan amount has the right combination. So in the end, just really a simple math formula, and that's what we're going to look at here for you.
Yeah, man, the numbers don't lie. That's one of the things I like about infinite banking. That's one of the things I like about this. Like, we're not skewing the numbers. We're not trying to make them look better than they actually are. It's just the math is the math. So, for people out there that don't exactly understand what a HELOC is, I wasn't even aware of this, first lien versus second lien HELOC. Can you kind of explain the difference of those two things and how what we're dealing with, the first lien, tends to be more useful if it's something that you can qualify for?
Yeah, for sure. So great question, because there is a difference. The A line of credit is um, the accessibility to the equity that's in the house. So traditionally, you have your first mortgage, so you have your payment on that, and then banks offer this line of credits. Think of similar almost to like a credit card. You're going to have a max limit, and then you have a balance that you draw on, and you pay an interest-only payment on that. So that is what's traditionally called a second lien HELOC, because you still have your first mortgage.
Hmm.
Um, that's a very effective usage of accessing the equity in your house and being able to use it to pay off debts, or there's even strategies to use a second lien HELOC towards towards the similar pay down the mortgage. But what we're going to use is a first lien HELOC. We're actually going to replace that existing first mortgage with a line of credit. So same concept, you're going to have a balance and you're going to have a limit determined based upon the value of the house. And the sole difference is you're going to route, again, all of the income in towards the line of credit to decrease the balance and retain, and you also retain access to the equity. So as you're decreasing the balance, you still have the availability to draw out your expenses in the month. And then again, even further down the line, as you continuously decrease the balance, it's becoming your own banking system, because you consistently have access to the equity that you build up.
I think we've heard that before, becoming your own banking system. So, yeah, at the end here, we'll kind of talk about how these two things can go hand in hand. But let's discuss really quickly, Jayson, who this is for and who it's not for, because this is not for everybody without a doubt. And we don't want to waste your time if you're listening to this and you get to the end and you're like, oh, this actually isn't for me. I maybe don't qualify for this. So let's tackle this right off the bat. Who is this for versus not for?
Certainly. So it's definitely a positive cash flow situation. And each loan amount, again, will have the right combination, meaning we can have someone very successful with bringing $5,000 net income into the household. Maybe they end up spending 2,000 or 2,500 and they owe 100,000. They're going to pay off in 4 years with great success in that combination of those three factors. But if we change one of those factors, if that loan amount was 300 or 400,000, now we don't have the right balance between the three. So when we're reviewing this, it's looking at those three core items to see, are we in balance amongst the three? So typically, those that are a good fit are um, finding that we have consistent income coming in. We have relatively normal expenses, so we're not changing how you spend money. We're not telling you to lower your expenses. We're just looking at that combination. When it doesn't fit, it might be because of that, either that loan amount much higher than what the income and expenses are going to be balanced at. So that same original scenario, if we bring in 5,000 and we spend 5,000 on 100,000, we're just not going to go anywhere. So we may have to look at, well, what's making up those expenses? Could we pay off an auto loan? Could we pay off some credit card? Now we owe 130,000, but we brought our expenses down to maybe 2,500, and maybe now we're in the right scenario.
So this is definitely useful for people who have some debt. Like again, when we're looking at infinite banking stuff, one of the first things that we like to tackle is the debt because there's a lot of money going out at usually much higher interest rates. And so if we can knock those debts out and we can reallocate that money, it can be more useful for us. So you're saying for people with debt, something like this can definitely be beneficial to help tackle some of those, but reallocate those funds back to paying that kind of inside loan off versus an outside debt.
Correct. So a common scenario that we may look at that I can think of is, let's say, an auto loan, 30,000, typical average balance, average payment 650. So that means you've got 4 to 5 years left to pay for it. So often we'll look at, if we increase our first lien HELOC balance by that 30,000 and we take away that 650 out of the expense column, now what's our payoff time for that auto loan? And a lot of times we'll end up seeing between like a 10 to 14-month period of time, just because of that power of 650 moving from one box of expense to income and being used to attack the entire debt as well too. So
Yep.
those are some of the factors we look at. Which debts does it make sense to add on? If it didn't shorten that timeline, then we say, yeah, let's leave that here, and we'll factor out the other debts. So
Okay.
very useful towards debt consolidation, towards lowering our household expenses as well.
Awesome. So let's transition then. Again, a lot of similarities here between First Lien HELOC and infinite banking. Actually, let me rewind really quickly before I jump into that. So, is there times when somebody may not be the right candidate for a first lien HELOC, but they still may be a candidate for a second lien?
Absolutely. There's going to be times where either the the loan amount is much higher, so now we need a much bigger factor of dollars in versus dollars out to really make the spread work. So sometimes we may step into the first lien HELOC by using a second lien chunking method where we're chunking down on the first mortgage until we get to the right combination. So first lien is kind of our option A. Second lien would be like option B, because the first lien is a one pot system. Everything's flowing in automatically to the checking and then automatically that night moving back and forth between the line of credit. So it's a very simplified process, whereas a second lien HELOC strategy is a three pot system. We're moving between checking, line of credit, back to mortgage, back to checking. So very much of a more manualized process there.
Yeah, sounds like a lot more work. So, but you guys do both of those in-house? You offer both of those services in-house?
We just do the first lien HELOC and then specialize in that niche product.
Okay, good to know. So, like I was saying, a lot of similarities here between infinite banking and the first lien HELOC. One of those being, depending what company you have your policy with, you have some give you the option of a variable loan rate and a fixed loan rate. There's very similar thing here with the first lien HELOC. Do you kind of want to explain the differences between those two things and which one you guys tend to go with?
Yeah, so on the first lien HELOC, the three core items that we talked about, the income, the expenses, and the loan amount, those have to be in the right balance for this to be a success. And when they are, the fourth factor in this is interest rate. But if the strength of the first three are in line, we're removing that factor of the interest rate. So for us, we're using a variable interest rate, changes each month. Sounds really scary, but that's again the shift in the mindset that we're using towards in our game book, we're looking at what's the volume of interest and what's the total time of interest. So if we're shrinking our mortgage from 28 years down to 5 to 9 years, well, now we've compressed that interest amount and we've really effectively lowered it, even if the variable interest rate ranges from 5 to 9%. As long as we have those first three items in balance, that's what's going to negate that fourth factor. Because, like, back to that original scenario, if we had 5,000 come in, 5,000 go out on 100,000, I could give you a 1%, but you're always going to stay at 100,000.
Yeah, yeah, that
If I
makes
give
sense.
you, yeah, if I give you 9% and you bring in 5,000, spend 2,000, you're going to pay off in 4.8 years and you still very effectively push down the volume of interest.
I think that's oftentimes what a lot of people focus on when probably first looking at this. I know we've had conversations about this, and luckily, because my wife and I are in the infinite banking space and teaching people this, that concept is very common for us. The higher number over here, the lower number over here. A lot of people see, oh, I have this 3% loan rate on my home currently. Why in the world would I go for something that's 7 or 8%? And when we get into my example, we'll kind of show you guys the numbers and how that actually really doesn't matter and how what they're really doing is confusing you. They're kind of uh, they're not giving you all the details when you sign those documents originally for your home because we're talking about this long extended period of time, this amortization schedule. So all of that stuff factors in. But Jason, let me ask you, how do you know this will work for someone or it won't work? Like, where's the kind of cutoff? You kind of touched on it a little bit with the examples that you were giving, but is there kind of a hard, fast cutoff where you guys know this is not going to work for somebody?
Yes, we go through that conversation. So a lot of times we're in our conversations, we're trying to figure out is it a right combination or are there other ways to get to here down the road? Because uh, our success is our client success, meaning our goal is we're trying to help people pay off their house in typically a 5 to 9 year timeline. So when we run our calculations and let's say we're at 12 years to pay off, that's still within our bell curve, a little bit outside of what we like as the norm. So once we start to go past that timeline, now we're going to start to see it's probably not going to be successful because when you get beyond 12, 14, 15 years, now $100 of expenses can start to sway that timeline. So
Mm.
it's going to be very cash flow dependent, and we don't want to put someone in that position to where we could swing from 14 years to 22 years. That doesn't replace their existing model that's probably in a better position. So that might be someone that works towards the first lien with like other strategies in place too.
Okay. So I think a common question, and again, we kind of get this in the infinite banking space, not so much towards my mortgage specifically, but when talking about the first lien HELOC, and you guys hear people ask, well, why would I not just pay extra towards my mortgage? You're telling me to do these different things,
Yeah,
create this one pot system. Why not just take that extra two, three, $4,000 and put it towards my mortgage payment?
that's a great question that we also often get. And usually the first question I ask people is, well, how long have you been adding extra to your mortgage? You've been on this for 4 years. And most common question is, well, I don't want to add extra because then I lose control of those dollars. I don't have access to it. Um, it's a great strategy. If you could put everything extra towards your principal, that's going to pay it down faster. You're going to decrease your amount of interest. But the second part of the first lien HELOC that ties in really well to infinite banking is as you put your money in, you still retain access to your liquidity. And then guess what you can do with your liquidity as you pay down? You can layer it into other wealth building opportunities. It ties great into that infinite banking structure. And now we're looping the dollars in a circle instead of it going one way.
Yeah, I think it's really just losing the access to those dollars. Like you said, sure, you could pay one, you're not paying that extra $2,000 to $3,000. Everybody's answer is probably, I haven't done it yet. I don't want to, just like you said,
Yeah.
because then
You
it's
feel like detached from that dollars. As soon as it goes away, it's gone. It helps, but you can't reach inside the walls and say, I want that dollar back. You can't call the bank and say, I want my 2000 extra that I put for the last year.
exactly. You can't particularly use your mortgage how it's currently constructed as a kind of emergency fund if something happened because you can't get access to those dollars. But if you had something like this in place and you sent that payment in and something happened, transmission goes out, you need 1,000, 2,000 bucks to replace that, you have that two-way street there, that line of credit that you can get in and get access to. So
E- Exactly. And then the other, in that scenario, the only way to get your money back is guess what? To refinance, do a cash out, reset your amortization. That's what the bank's hoping you'll call them for.
mhm.
To get access back to your equity, or they're going to offer you a second lien HELOC while you still have this first mortgage. So again, you're adding debt while trying to decrease debt. So here we're combining that. You're decreasing the balance while retaining access to the liquidity.
So that kind of led into my next question was like, what are other similar things to the concept of a first lien HELOC? You mentioned cash out refinance. Obviously, we kind of know the second lien is a potential option. Is there anything else out there that is doing a similar style thing? Obviously, not to the level that the first lien does for you with that liquidity and that access.
Yeah. Um, Again, it's going to just be about how you direct the dollars in. Outside of the first lien, you are going to have your second liens or you're going to have your extra principal payments. So those are kind of going to be your main strategies towards debt reduction on the mortgage balance there.
Okay. So if somebody was interested in doing something like this or looking more into it, what does qualifying look like versus getting, your normal mortgage on your home? What does that process look like?
For sure. And s- many similarities, a couple differences. Similarities are going to be your four pillars of credit, typically your credit scores. You want to typically be above 680, most times 700 are going to give you best scenarios for approval. Loan versus value. Um, Banks are going to get an appraisal, determine how much they're going to give to you as your limit. Majority of time for a first lien HELOC, it's going to be around 85% of the appraised value. What's nice is on the first lien HELOC, there's no mortgage insurance. So we can go to that 85%, replace a mortgage. There's no PMI. So great scenario for people that bought houses in the last 3 years, maybe with an FHA and value went up a lot. And now we can replace it, get rid of that PMI. Um, uh, we're also going to review income to substantiate that amount covers the debt. So there's a typical debt to income ratio, and then reserves. A lot of lenders in this space will want to see that people already have a pattern of saving.
Mm,
Um, so, for example, that we may require 5% of the line amount in some type of checking, savings, 401k, IRA. So let's say, for every 100,000, we want to see 5,000 in some combination because that's establishing a pattern of savings, which is pretty important in this strategy.
definitely.
Um,
You know where else that money could be, you guys?
in your
In bank policy. In your
That's correct.
participating
We
goal.
will accept a cash value policy statement saying you have 5,000 available.
Because it's an asset.
Yeah.
Awesome.
Um, and
Care.
then some of the differences might just be how we stress test a line of credit. Is going to so it's going to be a little bit more stringent than your typical conventional loan. Let's say per 100,000 on a conventional loan, they may qualify the house payment at $700 and we're qualifying it at $800. So that's going to impact the debt to income ratio a little bit as we qualify. Um, Very similar as well. Chances for approval are going to be a lot higher with W-2. Pretty straightforward. Here's your gross income. Here's how we qualify. Self-employed rental properties, we're going to see a little bit more challenges as we take deductions from those, which minimizes our income. And so sometimes we just got to look at what's our net income on self-employed or what's our income on our rental properties and how's that impacting our bottom line.
Definitely. Yeah, my wife and I went through this process, you guys, and we got approved. And I'm going to be honest with you, and Jayson knows this. With infinite banking, the idea is let's not do business with banks. Now, there are circumstances where things like this, where you're like, I have money sitting in the two by fours and the walls in my house, and I want to utilize that. And the only way to utilize that is to do some business with the bank. Now, with the first lien, you get to be a bit more in control of, like we said, the flow of the cash and everything compared to some of the other scenarios and options out there. But going through that process, there's still a lot of documentation that they require. It is a bank that you're doing business with. So there's some hoops that you got to jump through. And just like Jayson said, if you're a 1099, all of these things are something to take into consideration. But if you're looking to start to grow your wealth and create some passive income and do these things, I highly suggest this being something that you look into. And tell the people this, Jayson. Once you get approved for it, how long is that line of credit, that HELOC, good for?
Yeah, so it's a 10-year draw. So you're going to have access to that liquidity for 10 years. And then after 10, you have a couple options. So if there's any balance left after year 10, that's going to convert to a 20-year principal and interest. We can't exceed a 30-year timeline. If you have a zero balance by year 10, that's our ultimate goal. Couple options there. You're either it's going to close out and you get a lien release, you're done with your mortgage, um, or we could requalify and reset the timeline for another 10. So if you get done in 5 years, you're going to keep that available line of credit open till year 10 because there's no annual fees, no prepayment penalties. You still want to have access to those funds.
Definitely. And I've heard a lot around this space of infinite banking that go see if you qualify because one, banks oftentimes don't want to give you a line of credit when you need it. It's more so when you don't need it. So if I were to get this in place like we have now, but I didn't need the funds, is it fine? What happens if I just let it sit there?
Absolutely. That's the beauty of it as well too. You have, let's say, if you very common scenario that I've had is we've done a first lien HELOC on a new house, sold the old house, funds proceeds from the old house, paid down the new first lien HELOC. We're sitting at zero. There's no monthly fees, no annual fees. You still have access to the line of credit for the 10 years. You keep it there in case you need it. So
So And don't worry, guys, we're going to get into my personal situation and illustration here. We'll go over some numbers, and this will start making a lot more sense to a lot of you guys. So hang in there, but want to make sure we get these few other questions asked. Now, I know this is important and a question that a lot of people probably have for you, and I knew this was something that I had, but is this something that can just be used on your primary residency, or can we use it on rental properties as well? And then to piggyback on that, what states are you capable of doing this in versus, not capable of doing this in?
Gotcha. Good question there. So the bank I work for Savings Bank, we only do the first lien on an existing primary residence at this time. Certainly reach out to me. I've got other resources in the industry that can do second homes, investment properties. So there are resources for that. And then in regards to states that we're capable, all states but Maryland, New York, Texas, Alaska, Hawaii. So
Nice. So the majority of the states, you guys, if you live in any of those states, I'm sorry, move. Or do the second lien and you just have to go through more steps to go,
yeah.
about that.
Always reach out. Like I'm sure I'm pretty resourceful in finding options for those states too.
Speaking of resources, what if people are trying to learn more about this? Do you guys have helpful educational resources that you can point people to?
Firstlienheloc.com is a great resource of information about learning about the first lien HELOC. And then we'll throw up my link tree with my calendar and contact info.
Definitely. All right, guys. Well, if you made it this far, good for you. We're about to dive into the personal example. Again, this is my wife and I sat down. We went through this whole process with Jayson, helped us lay everything out. And when one of the first times we met with him, this is the information that he brought us after we provided him with our personal information. So you guys will see a breakdown here of our real numbers, and we can Jayson will walk you through how exactly this works, a couple of the different terms, like we said, the fixed rate versus the variable rate, explain the sweep features because that's can be a little confusing for some people. But yeah, I'll let you kind of dive right into this, man.
Yeah, perfect. Hopefully you can see the screen here. We got the mortgage versus HELOC calculator.
Yep, I got you.
And on our left side, this is what you came to us with. Said we just bought a house, not quite a year, and owed 248. I think it appraised what 400 almost 350,
It was
400.
four, maybe 450. We had put a
Okay,
100,000 down or 160,000 down on it.
perfect. And we had a 599 30 year with taxes and insurance. We ended up with around an 1850 payment. So we looked at, all right, let's replace this with a first lien. And so over here on our right-hand column, we have the first lien HELOC. We just did an apples to apples side-by-side balance comparison. And part of our conversation that we 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 start with is outside of what's your current scenario. Now we want to dive into what's the household income that's coming in and what are the sources? Is it W-2, 1099 combination? Is there rental income? And what is actually hitting the bank accounts, not the gross amount. We want to look at the net amount that's coming into the checking account. So we kind of looked at a factor of about 10,000 conservatively, saying that's typical deposits in place. And then the second factor is going to be expenses. So in this box, because we replaced the first mortgage, we've taken the 1850 out, and now we've said we've got about 6,000 of expenses. So otherwise, we'd be close to about 7,800 that is going out currently. So you have about 10 coming in, 7,800 going out, leaving about $2,200 of cash flow. So in this scenario, now we start to look at taxes and insurance. In the first lien HELOC, we don't want to put money aside monthly and let it sit there. so we do not escrow for it, but we account for this as an annual expense. So we want all $10,000 that comes in to attack the balance, and then route the taxes and insurance out as they come due in the year. So in regards to the sweep, how this kind of works before we look at the results down below, let's just run through that. So if 10,000 comes in tonight at midnight, the checking is going to move it to the line of credit. So checking is going to sit at 0, and our balance went from 248 to 238 automatically. And again, we're using this as a one-time event. Most people, it's going to happen every 2 weeks or weekly. But then from there, same thing with the expenses. Probably going to have expenses run throughout the year, throughout the month, but we're using it as a one-time event. When expenses come out of this checking account, even though checking is sitting at 0, when they go out, it's going to add back to the balance over here. And of course, there's no fee on the checking account. There's no overdraft. That would kind of be mean. But we add back to the balance. So now we owe 244. And here is where then the concept is a little bit different than the left side. Over here, your interest is already calculated based upon your original balance interest rate and term. Over here, it's going to be based upon what's our daily average balance between that 248, 238, and 244. So if we did this right, we held our balance at 238 for the most days possible, which then would give us the interest of 1512 for the month instead of 1550 or 1575. So again, our daily average balance was determined by how many days did we keep our balance at 238. And just a little part of this strategy, what we would be doing with this 6,000, we'd be putting as much as possible on a credit card, and then paying that off towards the end of the cycle. So our income did hold that balance there at its lowest point.
Makes sense. Yeah. So you want to keep that balance owed as low as possible for as long as possible. Rack up your normal bills on your credit card. So make sure you guys are double dipping, getting those points, getting those miles, all of those things. And then at the end of the month, or as close to the end of the month as possible, take that loan from your line of credit in the HELOC, pay off the card, and do it again.
Yeah. And then that way we're minimizing that interest calculation. And then if we continue this cycle month over month, here's what the actual results start to tend to look like. So now over here on our 30-year fixed mortgage, we were at 599. You end up paying 286,000, even though you have 248,000 borrowed. So you're paying more than what you have as an outstanding balance. And that's what this is indicating. 115%. You're 115% over your balance with this amortized loan at 599.
So hold on, I want to make this clear for people. Go back down to those numbers. You're saying I already paid we purchased our home for 160, give or take, or 410, give or take. We put down 160. I owe 248 something, give or take, left. You're saying that with this old style of the amortized mortgage, I'm paying an additional $268,704.85 in interest if I stick with the plan that they gave me.
Yeah, you're repaying the bank more than what you're actually borrowing.
Okay. And
Yeah.
what about the
So
rest?
so who does that favor?
Yeah. Not me. I mean,
Yeah.
that's not a surprise.
Yeah. And again, let's say you had that extra $2,000 per month, you put it all here. Fantastic. You're going to pay it off in 7 years, decrease your interest to 59,000. So that could have been a plan. We could have just said, "Hey, Shawn, got the great plan for you. Just add 2,000 extra per month. and you'll pay it off in 7 years, but you don't get any of that $24,000 back per each year. It's locked up.
Yep.
So again, that strategy can work if you're willing to give up control of your liquidity.
Yeah.
Back over here, dollars in, dollars out, 7-year timeline, 76,000 of interest instead of 286. So now look at our percent of interest versus the principal. We've shrank that from 115 down to 30. Another interesting scenario here that we put on our calculators that we like to compare. We're saying if a bank gave you a 30-year fix of 248,000 and made you pay 76,000 of interest, we solved for what interest rate would they have to give you. So in effect, you're having the same scenario as a 1.88 mortgage.
Mm.
So let's say come back up here. Look at that.
Look at that.
The bank then, if the bank only would have offered you 1.88%, we would not be in a scenario to replace your first mortgage. We would have said, hey, you're in a good position at that 188. Stay with what you have. But
So
that's not the case.
talk about a little bit how that rate, that 7.625, also decreases, because we're talking about going from an amortized loan and interest that's calculated one way to simple interest with your first lien. Because again, people see those numbers. Hey, I'm not that great at math, but I know 7.6255 is bigger than 5.99. Like, how is this favoring me?
This is our most common scenario that we often come. People refinanced 3, 4 years ago down into the low threes. So now they're 4 years in. And this is exactly it. Like 10 out of 10 people, if we only looked at these two top numbers here, which one are we going to take? We're conditioned to take the left side, right? Over here, it's scary. It's a 7.6. It's variable. It's going to change each month. But that's just one of the four factors that we have to consider. Over here, this is the only factor that people consider. Over here, we got to consider balance, income, and expenses. And again, we showed that now those same 10 people would be like, well, let me have that right side. Can I have 7 years versus 26? I am still paying. So that's part of the shift in thinking in regards to let's look at the other factors outside of the rate. There's 4 items that can control your payoff and make it advantageous.
So explain to the people, we had chatted about this before we got on, but let's say the annual interest rate goes up because it's a variable interest rate. We were talking about the difference between a little extra of a payment versus a higher annual interest rate, kind of what those effects have on the overall outcome of the payoff time.
Yeah, so let's come back to this is approximately where we're priced currently on our first lien HELOC. And again, our baseline is about 7.3 years, 76,000 of interest. So let's say interest rates go up 2%. We go from 7.6 to 8.1, increase the interest, of course. We're still outperforming this scenario over here. You actually probably had somewhere closer to that. So interest rates can play a factor. Beginning, we didn't even move. We didn't move much at all. We moved by 6 months. For interest rates go down, we go down to 6.7 years. So we're ranging from 6.7 to 8.1, 10.6. We're at 8.5. The highest is the rate that we've seen in the last 10 years has been 8.94. So we're well within the zone of where we're at. The other factor, so we saw how rate played a factor there.
Mm-hmm.
Well, let's look at income. Let's say we were pretty conservative on income in in reality, and maybe let's see what $1,000 extra does.
Yeah,
So that thousand
say I got money going out from my HELOC, and now it's bringing me in some additional income, some passive income, and I'm looking to put that somewhere. Extra $1,000.
dropped us down to 5.3 from the timeline there.
Hmm, that's just a
So
thousand
the
extra.
yeah, the dollar had the bigger impact than the rate. So again, that's part of the mind shift is the interest rates, fourth factor. First three factors are the most important that we have to determine what's the balance between them. So because as you start to get a different outcome of income versus dollars in, look, now we're down to like 4 years. So that's hustling for two extra grand to go from 7 years to 4 years.
And again, guys, a lot of the time, if you're doing this correctly and you're involved with the communities that we're in, it's about taking that money and putting it to work. The first thing, of course, is paying off debt. So we're rerouting some of that uh, poorly used dollars that we're sending out to third parties back into our system. But once you clear that debt and you now have available cash to go use and make money with, I mean, bump that thing up to 14 grand. I mean, we're looking at doing some pretty awesome stuff with the cash in our HELOC and having some pretty solid returns. And if the goal was to pay off the house, then
Whoops. Yeah,
then
let's say you took out 100,000 and you layered it into something that start off at $2,000 of reoccurring income per month. So we've gone to 350, income's increased. We've increased the loan amount, income has increased too, but now we've also shortened the timeline to pay off the 350. So now we're down at 6.5 years. And now we could say, okay, well, how long again before we could repeat that? Like almost another 2 years. So in 2 more years, you paid it from 350 down to 250, you draw another 100,000 back up. Now you're at 14. So this is what we call cash flow stacking. We're adding cash flow to our incoming household dollars, and then we're stacking down the balance of the line of credit. And then it's a repeatable process. Obviously, you're going to have a system in place, something solid that you're drawing those dollars out to create those returns.
again, guys, look at that 30-year equivalent rate. You're talking at that point a 1.1. They're almost paying you to have the house there.
Yeah. And the interest is deductible because it has replaced your existing first mortgage. It's not a second lien, which have caveats into what can be deducted, what can't. So the majority of our clients still indicate that they have the normal deductions just like their existing mortgage.
Nice. So a lot of flexibility here, you guys, as long as your numbers end up meeting the requirements. Same thing with infinite banking. We're often not looking for people whose expenses equal or exceed their current income. Sometimes by reallocating some of those overpayments that you're making, we're able to, help you kind of turn that wind current a little bit and get ahead of that debt. But Jayson, where a lot of people always think, glass half empty type of people. So where could this potentially go wrong? Like, give me that scenario.
Yeah, and so part of our conversation, that's exactly what we want to look at. So we're saying we have 10,000 coming in, 6,000 conservatively going out. So we start to look at what's that point of expense where now we're outside of the zone. Certainly 78,000 would be it, but let's change that to 7,800. So now we can start to say, all right, if we look at your bank accounts and that 6,000 truly isn't where we're thinking and you're closer to the 7,800, now we're going to be treading water and breaking even in comparison to your current loan, to where we're going to say, all right, well, the first lien may not be in the position to excel against your current mortgage. So that's where in our conversations we're diving into these two boxes. And this box is pretty easy. to look at. There's ways, you could get apps that track your expenses. You can pull up your checking account, go through your transaction history, take out your mortgage and any other debts we may pay off, and we'll get an average of what this is. So that's, again, what's going to determine is it a right fit. And now we can put like our ceiling as well too, because expenses vary each month. There's months of vacation, holidays, things like that. But we want to find that average over that timeline. So for your scenario, we kind of put a 7,200, 7,000 to 7,300 kind of ceiling as where expenses would bring up our timeline.
Mm-hmm.
So, and then we looked at 6,000 was kind of probably on the conservative high side, built in for the travels and vacations, things like that. So that's kind of really what we nail down the focus. Is it a good fit or not?
Yeah, it's very situational, guys, which is why, again, with the infinite banking stuff, you got to meet with somebody like Jayson, like myself, sit down, have those conversations, talk about what your actual personal lifestyle and situations look like, and what kind of debt you're bringing to the table. All of these things, I'll tell you. I'm sure Jason's the same way. Like, we've seen a lot of different scenarios, and we're not afraid to tell people, "Hey, I don't think this is the best thing for you right now." Uh, but you don't know unless you ask, unless you have the conversation. So,
Yeah,
um,
the fun thing with this is it does layer into different strategies. Like I often see, I call it, we have kind of three levels of clients. We have level one that our main focus and goal is how do we get this 248 to zero and be debt free, be mortgage free. And that's just income in, dollars out. That's going to be our kind of level one strategy towards maximizing that payoff and that timeline. Level two, we're going to kind of elevate a little bit. We're not so much worried about getting down to zero. We may take this 248 down to 200, draw out 48, layer that into an investment that creates cash flow, and then we repeat that cycle. So we're again kind of cash flow stacking there. Level three, even more intricate, we combine that level two, but now we layer in that infinite banking. So when we draw the dollars out of our line of credit, we place it into the policy to investment, and then we repeat the cycle over and over again. So just our conversations are where where are we at within those three levels? Majority of clients, I just want to get this paid off. I don't want a rental property. I don't want the headaches of that. I just want debt free and access to my equity.
yep. So again, Jayson and I, of course, Jayson utilizes this. Of course, I utilize infinite banking, but I also utilize the first lien HELOC, and Jayson utilizes infinite banking. So, Jayson, you want to give people, before we wrap this up, just kind of a quick example of how you and your wife kind of utilize both of these things in tandem?
Yeah, so we're more on the level three scenario to where we utilize the first lien HELOC, fund our cash value policy, borrow from the policy, and then go create items that generate cash flows. So we repeat the cycle. So we actually turned a hobby into a business. We love to ski. We go out west a lot. We were noticing, hey, we're paying 500, $700,000 to rent a car each time we're going out. So we ended up buying a car, found a host that would run our business, rent out our cars on Turo. So now we can have a car when we go out there. That did well, and we expanded beyond the first cars. So whenever we go to purchase a car, we pull from our policy, buy the car in cash, right? Pay ourselves back. All the income from the business runs through the first lien HELOC first. Then we draw from that to pay our policy back. So we're creating that cycle there.
Awesome. Awesome, man. Well, Please remind the people where they can find you, how they can get in contact with you. Of course, the information will be in the description of this video or in the description of the podcast if you decided not to take my advice and just listen to this thing.
Yeah.
Yeah, let the people know where they can find you at again.
Yeah. First Lien HELOC.com is a great resource for information. Personally, we'll put up my LinkedIn, um, or also Linktree as well, with contact information, book on my calendar, reach out, text, email, whatever. Glad to have conversations, and kind of point in the right direction and make sure, you know, kind of provide some guidance towards an alternative to the traditional way of financing. This is a great niche product that when it works, it has great results for people.
I couldn't agree more. And again, guys, just like with my scenario, all of my cash consultations are completely free. Same thing goes with Jayson. There's no charge for talking through your situation and finding out if this thing is the right fit for you. It's literally you just taking the time to book the call and sitting down and discussing the information. So if it's worth it for you, make it happen. If it's not, I appreciate you tuning in. Jayson, I couldn't be more appreciative of you coming on and kind of laying this out for everybody. I think this is a fantastic tool, and it is exactly that. If you figure out how to use it correctly, it can be a great way to bring some more control into your life. And then pairing it with infinite banking, I think, is kind of a no-brainer when that time comes. So I appreciate the time, man.
Yeah, absolutely. Great chatting, Shawn. Look forward to seeing your success with the First Lien HELOC.